All right, let's get this going. So today I'm going to talk to everybody about divergences and confirmations. So let's get started. I am Erin Swenlin of Decision Point, and we're going to look at divergences and confirmations today in my workshop. So we're going to cover, first of all, I want to give you a rising bottoms and declining tops line refresher. So we'll start with that. Then we're going to look at some classic divergences, and then I'm going to show you some classic confirmations. But then we're going to cover a few advanced methods, and that would be converging and diverging moving averages, as well as something called hidden divergences. And that one was actually somewhat new to me. I've seen them, I've heard of them, but I don't use them. And I'll talk about that a bit later. So first of all, we need to look at what rising bottoms and declining tops, of course, look like. First of all, you want rising bottoms because that gives you support or an area to watch for testing of price. And then declining tops, of course, that forms resistance. And there's really no such thing as a declining bottoms line, and there's really no such thing as a rising tops line. And you know, if you look at this, it should make sense. We want to see rising bottoms so that that's the test line, right? That's the support line. So what's important is that holds as support. You don't want to see anything break down below that. Well, if you're looking at a declining bottoms line, well, what are you going to get out of that? You know, sure, it could go down below that, and maybe then you're seeing kind of an increase in the price trend going the wrong direction. But in general, a declining bottoms line is considered not valid for that very reason, is you want to think about what's important to get out of that particular line. So the declining tops, of course, that is also valid because what you're looking for is a change in that trend. You've got a declining trend, declining tops, so you want to watch that as resistance and you want to see it break out, and that gives you information. If you're looking at a rising tops line, you're not going to get much information if it goes above it. You're not going to see anything. It doesn't form support of any kind. So it's not particularly useful. Now, of course, you could draw rising tops and declining bottoms lines, but as part of a trend channel. I didn't draw that in for you, but I think you can understand that. So if you're looking at, you know, the trend itself and see if it's matching, and then you could have that, obviously you'd end up with a rising tops and a declining bottoms if you were looking at a trend channel. But in general, when you're looking at trends and how we draw a valid trend line, that's how you do it. Now, let's talk about measuring divergences, because knowing how those declining bottoms are rising bottoms here, we're just doing that too, declining tops and rising bottoms lines. The reason that's important is because you want to start with the indicator when you're looking for divergences. Draw your rising bottoms or declining tops lines. Remember, those are the valid lines, but you're starting with the indicator. So you're looking at the indicator and you're going to draw your rising bottoms or your declining tops. Next, you'll draw the same thing on the corresponding price bottoms or tops. Now, of course, in this case, you might end up with a rising tops, or you might end up with a declining bottoms line. But that's okay, because really what we're talking about is the indicator. We want to start with that, and then we move to the corresponding price bottoms or tops. You then compare those slopes. If it's the same slope, if they're both going up, that would be a confirmation of that trend or the rising trend. So the same slope, you're talking about a confirmation. If you get a different slope, now you're looking at diverging lines, right? So that's when you get the divergence. All right, so let's look at a few here. So a bullish divergence, start with the indicator. Look for rising bottoms. That's a rising trend, right? In the indicator, that's what you're looking for. And then you connect those corresponding lows in price. And there you have your divergence. This is considered a bullish divergence. And you can think about it this way. You've got, for example, let's say this is a momentum indicator. If you're getting rising bottoms, that's telling you that even though you have these, the momentum may go negative and come back, it's turning up quickly. So you're seeing an increase in that momentum. If you start seeing the lower price lows, well, that's not really going with what you're seeing here. But the fact that the momentum is rising should tell you that despite having lower bottoms, you're going to get a move to the upside. So it's considered a bullish divergence. Let's look at it on a chart real quick. Started with the indicator. This is the price momentum oscillator, the PMO, the decision point indicator out there. And in my opinion, the best momentum oscillator. That's another story. So let's look here. We start with the indicator and we're looking at these rising bottoms. And then we come here and we see declining bottoms here. We're getting lower lows on price, but higher lows on the indicator. And that's considered a bullish divergence. And in this case, it seemed to be portend the future somewhat. We're getting that move, that rising trend off of that divergence. You could also call that a positive divergence, bullish divergence or a positive divergence. So let's look at bearish divergence. Start with the indicator, declining tops, declining tops. And when we compare that to the tops on price, we can see the tops on price are getting higher, but momentum, if that's what you're looking at as far as this indicator, is moving lower. Despite that, price is moving higher. That's telling you there's a divergence, obviously. Two lines are diverging, but it tells you that there's problems. If you're losing the momentum and you're going on a price rise, that tells you that there's a problem on the horizon. You should start to expect this rising trend in price to reverse. And let's look at it on a chart. Start with the indicator, declining tops, the valid lines, declining tops, rising bottoms. Start with the indicator. So we have declining tops on the PMO, and we have rising price tops. So we're seeing a deterioration of momentum, yet price is trying to push higher. It's similar to volume leading price, because you can also use this on balance volume, chicken money flow, any of those types of volume indicators. You can also use this for that. So think about it in that regard. If you're getting volume starting to dry up, but price is still going higher, that's telling you there's going to be a reversal in the trend. So you end up with a bearish divergence. So sometimes it's easier to think about in terms of volume. So let's look at some bullish and bearish confirmations. And what's the difference? Remember, with the divergences, the rising bottoms line would be divergent from the price bottoms. So in the case of a confirmation, we look for the slope of the indicator. Remember, declining tops, rising bottoms on the indicator. There you go, rising bottoms, declining tops. Now you look at the slope for the price by drawing the coordinating bottoms and tops to what you drew for the indicator. If that is the same, you're getting a confirmation of the trend and what's going on. So let's look at it here. We have a bearish confirmation. Momentum is being lost as you see these declining tops, but you have price tops also going in that direction. So you're losing momentum and you're losing price. It's basically confirming the fact you are in a negative trend. And it's similar for bullish confirmations. You see rising bottoms and you're seeing rising price bottoms. Momentum is increasing, or if this were a volume indicator, volume is increasing, price is increasing. That tells you that you should expect the trend to continue. It's a bullish confirmation. All right, so let's talk about some advanced concepts here. And I'm going to slow down just a bit because these can be very confusing. The hidden divergences. We're going to look at something called hidden divergences. And I've seen these. They're not used in classical technical analysis. I mean, I've been studying for the CMT designation, and so far all of the materials that I've been reading for that, none of them discuss the hidden divergences. So this is sort of an outlier, but it is something that's out there. And you can look at that. So let's talk about that just a little bit. Oh, and converging and diverging EMAs, they can be either a warning or a tension flag, or they can be confirming the trend. So it's sort of the same thing, divergences and confirmations. So let's start with hidden divergences. And I almost did not include this in this workshop because it might confuse the concept. So let's just remember before I get into this, starting with the indicator, rising bottoms, declining tops. Okay, the difference with hidden divergences is instead of starting with the indicator as far as declining tops and rising bottoms, you start with the price and you look for those bottoms and tops in price. That's a way to remember it. You're switching it around. So in price, you're looking for rising bottoms and declining tops like we usually do on price. And then we look at the corresponding tops and bottoms on those indicators. So it's a reverse of that process. And that means that it's the reverse expectation as well. So if you have higher highs on your indicator, and you have lower highs, the declining tops here, right? Like I said, price will give you the classic rising bottoms or declining tops. And then you're going to be looking at the indicator and see what's going on with the tops and bottoms. And in this case, you have rising tops, declining tops. That's considered a bearish divergence. So rather, it's a reversal to some degrees. And then here is a hidden bullish divergence. So you're looking at higher lows, rising bottoms on price, and then you're looking at lower lows on your indicator, moving lower, declining bottoms. I don't even use that term because it's not really what you're going to get. So, okay, so it's again reverse. So you're looking at rising bottoms and you're looking at these momentum indicators, volume indicators, whatever it is. You're getting the momentum is starting to really deteriorate here, but price lows are still rising. So that's telling you that despite you're getting that back off on price, right? And then you're getting that momentum is getting much lower. So really what happened was in this decline, you ended up seeing that momentum or volume very quickly decline. And so it's gotten more oversold. And so that would be why you have it being a bullish divergence. So it can be confusing, obviously, because, again, it's trying to figure out where you start as far as drawing those valid trend lines. So in the hidden divergences, you're going the other way, which means what you're expecting is going to be different. So you would think you've got lower lows on your indicators, so that seems like a negative connotation to it. But in actuality, because you've got the rising bottoms, that makes it a bullish divergence. So again, I know, kind of confusing here. So let's look at the hidden bearish divergence. You've got declining tops. That's your valid trend line. We started with price, declining tops. What's happening with the indicator? You're getting rising tops. So again, that's considered a hidden bearish divergence. Now in this case, it didn't result in a huge decline at all. When we look at the hidden bullish divergence, we have rising bottoms, and then we look at what's going on with the indicator, declining bottoms. It's a divergence, and that's considered bullish. And the expectation would be a rise, and we actually did see that here. I don't think you really need to use these hidden divergences. I personally think that it's probably going to confuse the point. I think it's much better if you're looking at just the classical divergences. They give you all the information you need. And if they aren't diverging and they have the same slope, then we know that's a confirmation of what's going on. A lot easier to remember. So I wanted to present these hidden divergences, but I also wanted you to understand that it's not really used in classical analysis, and it can kind of confuse the point. So let's look at converging and diverging EMAs. So when you're looking at converging EMAs, that means you're working toward some sort of crossover. It can be a warning if you're working toward a negative crossover. And if you're starting to work toward a positive crossover, that's, an alert. Hey, something good is getting ready to happen. Diverging EMAs, when they start to move apart, that tells you that you're getting a confirmation of the trend because price is accelerating in that direction. And so the EMAs are separating. So let's look at this a little more closely. So right over here, we have 3 warnings that there's going to be a downtrend. Notice that we have these EMAs and they are split, right? They diverge, they're moving further apart because you've got price accelerating to the upside. But then you start to see price move lower, and now you're seeing these moving averages start to converge on each other. So that's warning you, because of course you're coming in for that negative crossover, that's warning you that a downtrend is now in place, and you should be thinking about more bearish outcomes in these cases here. And in this case, of course, it really turned out to be bad news. Of course, the market suffered quite a bit through here anyway, but let's look at the confirming trend. And as you can see, we came out, got that crossover. It looks like a kind of a whipsaw decline and then move up. But you're starting to see at this point the EMAs start to separate and diverge. And that's telling you that that price trend is getting stronger as we move up higher. And here we go again, like I said, squeezing EMAs, and we're getting close to that negative crossover. And so that's giving you warning that the trend is likely to be changing. And similarly here, we can see the confirmation of that trend after we got the crossover. The EMAs are starting to stretch and move further and further apart. Over here, and I didn't draw it in, notice as soon as we start to see a squeezing of these EMAs, we start to see the distance not be as great. That's telling you to expect, that the trend is changing, and you can already see it was starting to change, and that's confirming that fact. So that's what you look for when you're looking at converging and diverging EMAs or moving averages. So that concept, I think the light bulb may have gone on for a few people. Remember the MACD? It's a moving average, convergence, and divergence. So let's go ahead and review. Remember that the MACD is the difference between 2 moving averages. And then you get the signal line by taking the 9-day EMA of this difference. So it's the difference between those 2 EMAs, which is telling you what, obviously, we'll get there. The histogram shows visually that squeezing and diverging of those EMAs. So let's look at that example here. So here's the MACD, and this is the 12-day EMA and the 26-day EMA. Your larger period EMA is going to be the slower one. So, well, I take that back. This is the difference between those two. And then this is the average of those. And so what we look for in the histogram is we're looking at the space between those 2 moving averages, essentially. And that's where you can start seeing the compression. As soon as you start seeing that histogram move down, you know that there's compression starting to take place. That's giving you that warning that there's possible reversal in trend setting up. And that's how you use the MACD. That's how it was determined, and that's how you get that. All right, so let's go over pretty much what I just talked about, and I'm going to cover a few charts. We'll just go look at a few as well for some examples. But I just wanted to refresh you on what we just looked at. So remember, we looked at what constitutes a valid trend line: rising bottoms and declining tops. Those are the only valid trend lines. We looked at classical divergences, and that was where you started with the indicator using this tool, rising bottoms, declining tops, using those valid trend lines. We started with the indicator, and then we looked at price. And when it diverged, when those two diverged, obviously that's your divergence and your classical confirmation when you're confirming the trend or confirming the momentum, however, whatever indicator it is, confirming the volume. You want to look for those declining tops and rising bottoms on the indicator to match, to make that a confirmation. And then we looked at a couple of advanced methods, which are those hidden divergences. And again, I mean, you can use those, but for me, I prefer to stick with the classical versions just to keep my head straight. Converging and diverging moving averages, we discussed the significance of looking at those divergences and convergences of those moving averages, because that gives you a hint as to, or a flag as to a trend that is improving or being confirmed, or it is telling you that you're getting ready for a warning or an attention flag because you're getting ready to have a crossover between those two moving averages. All right, so let's go ahead and we'll go look at a few examples here. I want to show you first, as an example, one of my favorite indicators here. And that would be the decision point indicators. And I'll show you the ultra short term, and intermediate term. And I know there's going to be some confirmations and divergences on there. There always are. So let's look at this one, and I will go ahead and annotate. So I want to get some trend lines going here. So let's move some of this stuff out of the way. Here we go. So remember, we're going to start with the indicator. So we don't want to look at rising tops, no such thing, right? We want to look at declining bottoms. There we go. Where are the corresponding tops on price? They are rising. What is that? That is a bearish divergence. And so that would tell you it's an intention flag, it's a warning that the trend is going to change. Well, in this case, let's face it, it worked out really well. Doesn't always work out that well, but there you go. So that was a bearish divergence. So now let's look and see if we can find some rising bottoms here. Here's rising bottoms on the advances minus declines in breadth. And now we're going to look at the corresponding bottoms on price, and they are declining. So that is actually, no, wait, we want to go to the tops, my bad. Compare tops, let's see, the bottoms to the bottoms. All right, declining bottoms. So in this case, you're looking at rising bottoms and you're looking at declining bottoms, and that is considered a positive divergence. And in actuality, when I look at this, of course, these lines are actually converging, but we're looking for the differences in those lines. So again, bottoms to bottoms, tops to tops, and we start with the indicator. So in this case, this was a bullish divergence. And what came out of that, we saw that move upward, and we got that trend change. So that was in the climactic indicators. Now let's look at the short-term indicators and see if they are coming through the same way. One thing I am just, honestly, I'm kicking myself about because I haven't seen it, and it gave us a really good warning on this decline. Let's look at the divergences going on here. Okay, so what I was actually doing in this case where we had this move upward, and this is a little bit of an advanced concept because I'm going to actually look at the difference between these two indicators. One is on breadth and one is on volume. So I have a declining tops right over here on the volume. Typically, you're going to see these two go in the same direction. So let's show you a few of these. This is typically what you're going to see. They always really follow each other. So in this case, I have declining tops on volume, but what ended up happening, we had pretty much the same kind of a top here on, those were mostly equal. So that to me was a divergence that I should have picked up on, but I don't look for those typically because these indicators go in the same direction nearly all the time. So I didn't pick up on it. I wish I had, because we see that we had this nice rising trend, and then we ended up having this divergence, and right after that we had this very big decline. So I did the difference between two indicators. I looked at divergences between indicators, and that gave me some information to look for in price. So that's a little bit more advanced, but that's how that works, and you can do that. And finally, let me look at these intermediate term indicators, and we'll look at a few advanced hidden divergences. All right, so we have rising bottoms here because we're starting with price for a hidden, and now we see declining bottoms that match that. This, remember, let's see if you can remember, this is considered a hidden bullish divergence. So again, it's sort of, to me, it doesn't make sense to me in my head necessarily, because I'm looking for the difference in an indicator. And when I see declining, I'm looking at declining tops. I'm not looking at declining bottoms. So it can be confusing, because declining tops and rising price tops is a negative. And this is confirming the downtrend, right? These two tops right there. But the hidden divergence, as you say, is these declining bottoms and rising bottoms, and that's considered bullish. So we got the decline off of this, well, we got the confirmation of this decline, and now we're starting to see, as far as a hidden divergence, we're seeing these bottoms declining on the indicator, but we're getting rising bottoms on price. So a little different. And like I said, the reason I don't generally follow them is because it can be very confusing when you're looking at them. And with that, I'm going to complete our Divergences and Confirmations workshop, and away we go. Here's what we covered again, just to refresh you. We looked at rising bottoms and declining tops. Again, think of those all the time. This is a good refresher for people anyway. It's natural for most, but I explained the psychology behind that. Then we looked at classical divergences and confirmations, and then we talked about some advanced methods, finding those hidden divergences that are not typically used in TA. And then we looked at converging and diverging moving averages, and of course the MACD, which is a indicator for converging and diverging moving averages. So with that, I am concluding, and I hope you enjoyed my workshop. I hope you learned something, and that's it.